Hi traders, Steve here from Jackrabbit Trader, and in this video I want to take a look at the 3 stock market trading strategies for beginners. So if you're just getting started, you know that there are many different ways that you can go about trading the stock market. If you're going into the stock market, you know that it's a daunting task, and I'm here to try and help you with understanding a few different ways that you can move forward and gain some exposure into the stock market. So the first and most common way is through index investing. And a lot of the personal finance gurus talk about this being the ultimate uh, strategy. I disagree, and we'll get to that a little later. But I do think there is a place for this strategy in everyone's portfolio. I personally have it, and you may as well, in my 401k through work. And you can also look to do it in your own retirement accounts through a Roth IRA or something along those lines. But essentially, the goal of index investing per Investopedia is index investing is a passive strategy that attempts to generate similar returns as a broad market index. Investors use index investing to replicate the performance of a specific index, generally an equity or fixed income index, by purchasing exchange-traded funds that closely track the underlying index. So exchange-traded funds being ETFs, or you can look at some of the more common mutual funds that you would find in a 401k, like a Vanguard, or other ones through Mass Mutual. There's a bunch of different funds, but the goal of the whole process is that every week or every 2 weeks or every month, whatever the case is, you're going to be investing and contributing money to your account. On the opposite side of that, the account holder is going to take the money that you contribute, invest that money into the said instrument, whether it's a mutual fund or an ETF, and over time, you're going to contribute and accumulate shares of that fund. Now, the goal with index investing is long-term growth, all right? So some of the pros for index investing: minimal time commitment, right? We just talked about it. Really, all you're doing at the end of the day is taking money, contributing money to the account. It's either being auto-debited from your bank or your paycheck, whatever the case may be. It's going to that fund. That fund is securing and buying shares for your portfolio, and over time, you're amassing more shares. Now, as you amass more shares, what happens is the whole compounding interest starts to kick in, and your money that you're contributing and you're gaining is making more money. So obviously, minimal time commitment, easy to get started, and multiple buy points obviously provide a better cost basis. So let's look at that. Let's go to the charts real quick. Take a look. Let's change this to, let's go to a 10-year monthly chart. Actually, let's go to a 10-year weekly chart. And you can see, obviously, over time, this is a chart of the SPY, the exchange traded fund for the S&P 500. And you can see over time that the SPY is moving higher, right? So what's happening is, again, this is a weekly chart over the last 10 years, but say every month, let's just say you're contributing $100, right? $100, and you're doing it every month. So over that time period, you're starting to basically average into a position. So while you do have many buy points along the way, your average position is usually lower than where you would the market would buy. So that is a way that you help prevent risk by contributing money slowly over time. You're not putting all your money in at one time, and you're basically averaging into the market, keeping that buy point lower. So you may have buys from 10 years ago on the SPY down at, say, $90, and it's trading at 300. So yes, over time, there is a definite advantage to index investing. But the problem with index investing, and one of the flip side of it, is you're investing for the future. Okay, you're putting this money to work in a retirement account For me, for argument's sake, I'm 35 years old at the time of this recording. I'll be actually 35 years old. Regardless, you're investing for the future. So I'm putting money away in my 401k, amassing that money, and slowly building that account for use when I'm 65, 55, whatever the threshold is for that retirement account. So there's no income potential, all right? There's no income potential right now for me to take that money, invest it, trade it, make money with it that can supplement my income today. All right, so those are two of the downsides for index investing. The other one that, there's obviously something to be said, and traders come from two different sides of this argument, but there are going to be times where you're going to experience drawdowns. All right, and let's go to one of the most famous ones. Gotta go back a little further, actually. Let's go to the 2008, 2007 collapse. Okay, so at this point, if you were investing, and many people, that were close to retirement, that were going about this strategy, and if they weren't managing their money properly, maybe experience significant declines. Okay, this is a time when the S&P went from right around 155 down to 70. So basically half of your money was involved with this drawdown. And the other part of that is now you're in a, think about it from an emotional standpoint, you've lost half your money. You're going to be pretty reluctant to put it back to work and potentially capitalize on what's been a bull run, a bullish market from those lows. And you could see if we draw a quick trend line here, I could tell you exactly from the low to the highs is a 339% return. So 339%, obviously you experienced some drawdowns. So in that drawdown, fortunes were lost and fortunes were made. And this is where the two different sides of the market or of the trader's psychology comes in. If you look at the idea of index investing, you need to be involved in the market all the time, all right? Regardless, you cannot take your money out. You have to just trust the system, trust that, when stocks go down, when markets go down, you're getting better prices because, again, you're investing for 10, 15 years in the future versus tomorrow. So that's index investing. Again, I completely think that this is by far one of the best ways to amass fortunes, but understand that there are risks involved with drawdowns. There is no income potential at this present moment, and you're investing for the future. But based on savings rates and everything like that, there's really no better way to put your money to work if you're looking for a minimal time commitment. So that takes us to our next strategy, which is dividend growth investing. Dividend growth investing is very similar to index investing. You're putting money to work over time. You're looking to auto invest those contributions, but the goal here is a little different. So it's not only long-term growth, but it's also potentially passive income replacement. Okay, go on YouTube, there's a bunch of videos that talk about dividend growth investing. And the idea here is that we're able to invest money over time and generate $100, $200, $300, $400, $500 in passive dividend income every single month. Now, again, great benefits to it. Obviously, there's the added income replacement component, but there's a couple caveats. All right. Again, we're still investing for the future because ultimately you have to keep that money involved. You have to keep that money in the account, fully invested to get the bang for your buck, because you're really not looking for capital appreciation. While it is an added bonus, you're looking for that dividend replacement, that passive income replacement. Again, still the same issue. You can lose on drawdowns. You have to be invested. But the one significant problem that I see is you can lose more with your depreciation on the instrument. All right. Obviously, we're investing for the long term. You want the asset to appreciate over time. All right, again, looking at the SPY here on this 15-year chart, we talked about a 339% gain. Obviously, there's dividends involved there, but this is a perfect opportunity. You made 339%, you were involved. But what about stocks that are those high yielders? And this is where people get a little confused, is if you go over and we look at some of the highest yielding stocks, and this is where, let me be perfectly clear here, this is where dividend growth investing gets a bad rap because people don't fully understand it. You're not looking for the highest yields. You're looking for the companies that continually grow the dividend. All right, but for the purpose of this video, let's take a look at some of the highest yielding stocks. All right, we have MAC, CTL, IRM. All right, let's take a quick look at those over the last 15 years. MAC, all right. So basically, over the last 15 years, it's gone sideways. 15 years ago, it was at 46. Today, it's at 33. IRM, okay, similar situation, going sideways. So while you are collecting that 7-8% dividend, the stock's not moving, all right? And again, this is where dividend growth investing gets a bad rap because it's not about the highest yields. It's about stocks that continually grow their dividend. But on the flip side, those stocks are not yielding as much. All right, so I did a little research because I'm not a dividend growth investor, but I love the idea and I think it'll definitely be part of my portfolio one day. But Walmart is one. All right, so Walmart is definitely one that would have been great to be involved with. 52, now trading 114. But if we go to the trade tab, what are we yielding? We are yielding 1.85%. Okay, not the best at the end of the day. Something like Procter and Gamble. Okay, again, chart looks great. 55 to 115. Trade tab yielding 2.57%. All right, let's look at another one. Realty Income, all right, one of the REITs, the real estate investment trust. Again, huge name here, moving forward, moving higher over the last 15 years. Going to see what that yields, 3.89. So there are ways to go ahead and still contribute with dividend growth investing, still get that capital appreciation, but you have to do your research. All right, you're looking for the names that are not the highest yielders, but the names that are continually raising their dividends, continually increasing them, and you know that dividend is safe. So there's some work to be done there. The great thing about trading right now is there's a fund for that. I'm not 100% sure what that is. It's a Vanguard fund. I think it's SP. I'm sorry. There's a SPYD, I think. Yeah, high yield. Pretty sure that's what that is. High yield. But then there's a Vanguard. I think it's like VYDM. Again, not a dividend growth investor, but just know that there are options out there that you can basically combine dividend growth investing and index investing and contribute and achieve both goals. But again, understand the risks. Okay, you're invested 100%. You may lose on depreciation. You're really going for that dividend. Okay, so next strategy. All right, and this is where I tend to come in. All right, I'm more of an active trader. All right, but active trading has its own caveats. All right, so again, going back to Investopedia, active trading is defined as buying and selling securities for quick profit based on short-term movements in price. Active trading requires a more speculative outlook than buy and hold strategies. This makes technical analysis, which is a predictive method based upon equities price charts, and an attractive tool for active traders. Okay, so what does that mean? All right, at the end of the day, we're looking to generate growth and profits. Okay, we're looking for profits to live off of, and we're looking for growth to grow retirement accounts, And again, in my case, 35 years old. I'm looking, 30 years down the line, but I need that income now. All right, I want that income now because that income now allows me to diversify my portfolio, right? Maybe I want to get involved in dividend growth investing. Maybe I want to add more to index funds, but I need that active income, all right, that active trading income. So the great thing about active trading is I'm in and out of the market when I feel it suits me, okay? I benefit if the market goes up or down, okay? I can be long stocks when the market's going up. I can be short the SPY when the market's going down to protect and hedge my portfolio. All right. It is possible. There's been times just recently. I'm doing this video in July of 2019, beginning of the year, actually, even as recently as 2 months ago. There were times that I was in 25%, 50% cash. All right. So I was able to reduce my portfolio size, reduce my position size, and protect a lot of my portfolio from those drawdowns. All right, so those are all great opportunities in active trading, but they come with a cost. Okay, so there's a significant time commitment to learn how to actively trade. There's a learning curve that takes years. Okay, many years. I'm doing this 15 years. I finally feel like in the last 3-4 years, I'm starting to understand and I'm starting to be consistent. So there's some time, right? You have to develop your process, a process that works for you and only you, right? I could tell somebody else. I have a buddy. He loves buying stocks when they're down 20-30% because he wants to buy good companies at cheap prices. That doesn't work for me. I'm buying stocks as they're making new highs. So everybody has a different way of doing things, but understand that you have to develop that process. And at the end of the day, in active trading, you're always second guessing yourself. Okay? No matter how good of a trader you are, you're always second guessing yourself. And, oh, I should have stayed in that stock. I got out of that stock too early. Whatever the situation may be, it's not as simple as here's my $100 every single month, $500, whatever it is, put it to the same fund, and slowly over time, I'm generating cash and generating wealth. Okay, we're looking to generate that wealth and also generate that income. So that brings me to where do we go from here? So what if you could combine the benefits from all of these strategies? All right, what would that look like? So we're looking for a strategy that has limited involvement during market hours. I work, 9 to 5. I'm a landscape architect. I don't have time to sit in front of a screen every single day and trade for income. It just doesn't. It's not possible. And I'm sure there's a lot of people out there that have the same issues. So that's where dividend growth investing comes in. That's where index investing comes in. But what if there was more of an active approach that was able to be implemented, outside of normal market hours? We want to provide long-term growth, right? We talked about this. We're looking for those 30 years down the road that, retirement, whatever it may be, that we want to make sure that we have some kind of funds available, and we're growing money over time. We have that time. We want to benefit from compounding returns, compounding interest. What does that look like? We want to provide income replacement. Okay, as I said, for me, I want to trade to make money. I want to trade to supplement my income. I want to trade that at the end of the year I made $30,000, and I want to put that towards house improvements or vacations or whatever it may be. Right? So there's that income potential that we're missing from from index investing, but we're gaining with dividend growth. But think about how much money you need to have for dividend growth investing to actually generate a significant return. Okay, even at 4% dividend growth on a $100,000 portfolio, you're talking about $4,000 a year. Okay, on $100,000, you need $1 million to make $40,000 a year. All right, there's other ways and maybe other benefits that you can look at to generate that same amount of money. We want to be in the market only when we want to be in the market, right? We want to enter and exit trades when the market is right and when we know we're going to make money, or not know that we're going to make money, but expect to make money. Okay, put the odds in our favor. All right, we want to profit from up and down markets. Okay, if the market goes down for 3 months, I want to still be able to profit from that. All right, in dividend growth investing, you can, because you're getting that dividend. Index investing, you're not. There's no profit. Okay, that profit is realized many years down the line. All right, and again, I want to raise cash when I can protect capital. When I need to protect capital, market's going down for 3 months. I don't want to lose 20-30% on my portfolio just because I want to be involved in the market. I want to make sure at that point that I'm moving to cash, potentially hedging my portfolio. So there's got to be a strategy that can be developed or has been developed that takes advantage of all these. And over the last 5 or 6 years, I've slowly moved into what I consider to be the ultimate trading strategy, and that is trading the weekly chart. So I want to look at a couple charts with you, some closed trades. And let's go back and we'll go to, now we're looking at a 4-year weekly chart. And I want to look at a couple closed trades that we've had. And I want you to just see how this process and how this system or strategy would work. So let's take a look at CDNS, okay? And I'll even go ahead and turn on all my trades that were made, all right? So the ultimate strategy I consider is trading the weekly chart. And we're gonna get into this more in next week's video, but I want you to understand that there are ways to profit from market moves, and all of my trading is done outside of normal market hours. Usually Saturdays, Sundays, I enter my trades, I look at my trades, I run through my scans, I even send out an email to my subscribers with all the trades that I'm looking at. So if you're looking for something along those lines to help you out, I'll leave a link in the description box below for my trade alerts. And I'll also leave a link in the description box below for my free e-course that goes into the weekly process. And as I said, we'll go over it a little bit more in video next week, but if you want to get a jump start, definitely check out the description box below. But let's look at CDNS, okay? This was a trade that I took here in February, okay? I took some profits right around $62. So bought 59 shares, took some profits at 62. All right, so just about a 20% gain there. It continued a little higher, took the rest of the position off, okay? And then we started getting a pullback. Now, did I know that this was a high? No, at the time. It's just about consistently making money, okay? I could have easily gotten back in back here in March, and we'll go over that whole process of how I get in and out, but just want you to see how that works. All right, let's take a look at another one, Procter & Gamble. Okay, another one here. Just got in, oh, let me set the right so you can actually see it. Okay, so got in that trade right here in February. Bought 63 shares at 97, bought another 29 shares at 102 on the second breakout, sold some shares at 105, sold a little bit more at 104, and again, had another opportunity to potentially get back in the trade, but over time, made some money. All right, so with all that said, let's take a look at just how well the system performs and the strategy performs, and then I'll let you go for this week, and then we'll pick up again next week. So these are the trades that I have made for the last 3 years. And you can see, you know, in 2016, lost 2,800, 2017, made 8,000, 2018, 11,000, and so far for 2019, up 11,000. This is the chart for all the trades I've made in 2019. You can see those broken out here in this view right here. This is the yearly compilation, I guess, of the names here. So all in all, made a total of $30,000 over the last 3 years. And you can see a couple big months here. One in May, June wasn't bad, 25.49. So far, July is shaping up nicely. So have some open trades. I have one in EA, which is my biggest loser right now. Based on the charts, if this stays where it is come Friday, I'll exit that trade. But you can see that my wins are not very large, right? A couple hundred here and there. And it's just about consistency. It's about taking that money off the table and moving forward. Again, we're getting that long-term growth and we're getting the income potential. So again, if you look at the annualized return, looking at right around $21,000 for the year, and that's not a bad year, right? For trading maybe a couple times a week, taking some profits when we can, and just doing it consistently. So we'll get into that more next week. Couple things, if you haven't had a chance to check out the website, jackrabbittrader.com, head on over there. You could see here's the free 2-week email course. All right, and then if you want to sign up for the trade alerts, both of those can be done there, and you could always follow along with my performance. Again, up 47% since I started in 2017 versus 33% in the market. Again, just that outperformance, that consistency, and making sure that we're protecting portfolios, protecting capital, and just doing it consistently. So I hope this helps. Again, I have no reservations with any of the strategies we talked about. My goal, as I start to evolve as a trader and start to amass a little bit more capital, is to definitely move into some dividend growth investing. All right, I have my index trading through my 401k at work, so I don't really need to touch that anymore. This is my active trading platform that I'm developing, and then as again we amass more money, where can't necessarily trade, a couple $100,000 easily, then maybe we start to move into some dividend growth investing. But that's the way I'm handling it. That's where I see this going. And again, if you want to be involved and you want to follow along every week, we're posting new videos here every Wednesday, and you can subscribe, hit that bell icon below, leave a comment, shoot me an email, whatever way you want to get in touch, just reach out, and I hope to see you next week. All right, take care, guys.